Hey students, welcome to week 7, Accounting and Business 222. Hope things are going great for you. Let's get into it. Quickly, the learning objectives for this week. We're going to look at and define what current liabilities are and what their fundamental concepts are, like what's driving those, the definitions of current liabilities. We're going to look at identifying, computing, and recording what's called definitely determinable. I use definitely determinable current liabilities and estimated current liabilities. We're going to look at the differences between those. And then we're also going to understand the differences between what's called contingent liabilities and commitments. Sometimes those two are a little bit confusing, so make sure you're reading the book specific. I'm going to cover them really quick here in this overview, but make sure you understand the differences out of the book as well. Current liabilities are debts, obligations that you have to pay. And usually the word current means it has to be paid within, the 1 year, within a typical or normal operating cycle of your business. And managers have to understand how current liabilities should be recognized, valued, classified as part of your job as a manager. So if you're responsible for a business unit, identifying your liabilities helps you also identify the risk to your business. So it's important. Current liabilities is not just an exercise in finances, it's really an exercise in understanding the risks that are underlying inside of your business. Timing is important in the recognition of liabilities. Sometimes failure to record a liability means failure to record an expense. So things get really out of whack. And they mention a couple of different errors lead to what can happen is you get an underestimate of your expenses or an overstatement of your income. And if you remember, like when banks and whatnot ask for your income statements and your balance sheets, you want those to be accurate. When your investors ask for those things, you want those to be accurate. If you're in a publicly held company, distribution that's distributing stock, then you want to make sure that your expenses are not understated and your income is not overstated. Otherwise, you could be accused of fraud. Let's see, talk about valuation for just a moment. Some liabilities have to be estimated. You won't know exactly what that liability is until it happens. We're going to talk in just a minute about some examples on that, but it's called an estimated liability. And the liability is generally valued at the amount of money needed to pay the debt or pay that liability off to make it go away. Emphasis on the word fair market value in this case. Current liabilities are due in the next year or within, like I said, the normal operating cycle. It's like within that time period versus a long-term liability, which is beyond the 1 year mark, beyond the normal operating cycle of your business. And the distinction between current and long-term liabilities affects how you evaluate the company's liquidity. So it's important to get that right. Let's talk about disclosure for just a moment. Any special credit arrangement, such as a line of credit, has to be disclosed in a note. We're talking about this one right here. Has to be disclosed in a financial note on your financial statements, probably on the balance sheets where it would show up. Any large notes payable should be disclosed on the notes section of your financial statements to let people know what's going on. Disclosure goes along with that term of being transparent with your investors. This concept of definitely determinable liabilities includes things, those are liabilities that are set by contract. Like you can definitely measure them. There's no estimating to them. You know what they're going to cost you if they come to be. So accounts payable, for example, is a definitely determinable liability. You can measure it. You can find it. As well as things like short-term notes payable. You got to pay those. So those are called definitely determinable liabilities. But there's also this idea of accrued liabilities that are not already in the accounting records, and they would include estimated liabilities as part of that. But interest payable, a definitely determinable liability, are examples of accrued liabilities. Cash dividends. We're talking about different kinds of liabilities here. Cash dividends are distribution of earnings to corporate stockholders. If you're a publicly traded company and you owe stock to people, or you have to stock with people, then if you choose to do cash dividends. So a corporation's board of directors has the sole authority to declare cash dividends. If you look on the stock market today, a lot of people aren't doing cash dividends. The stock market's doing so well, and companies are feeling like they don't have to do dividends to pull people into their company. Apple doesn't pay stock. At least it hasn't in a while, for example. A corporation has no liability for dividends until they actually declare that there's going to be a dividend. And then from the date of that declaration until the date of the payment, the cash value of those dividends are considered a current liability for the corporation, but not until there's a declaration that there's going to be a dividend paid out. Example of a payroll liability is like hourly wages across all the hourly workers and their hours. That's a liability. Salaries, people who work for an annual salary, for example. An employee's paid a wage or salary by an organization that's under direct supervision. That's an example of a liability, as well as any independent contractors that you might have working for you. Their services, their fees are considered payroll liability as well. This is an example of payroll costs. There's a lot that goes into it. You can see for the company, they have to track all this, but the employee, what you see in your check is this stuff right here that I'm outlining, all right? The employer also pays, so like you pay federal income tax, state income tax, FICA, Medicare, etc. The employer also pays their share of that as well, and then some. And there's also, here's the state unemployment tax, you got to pay that. Federal unemployment tax, you got to pay that. Additional costs that are not shown here, but they would be liabilities like workman comp insurance and that sort of thing. So these are all things that become liabilities inside the payroll scheme that shows up as liabilities on the balance sheet, and then expenses as well when they get paid out. The estimated liabilities are definite debts, like you can their obligations, the exact dollar is not known to them, so I'm trying to say. So they're debts that you have to pay, but the amounts might float a little bit based on what it is. Taxes payable, property taxes, promotional costs. Product warranty liability is a big one. May or may not happen, but you got to cover the cost for product warranty liability, for example. That would be an example of an estimated liability. A contingent liability is a potential liability because it depends on a future event that may or may not happen. Like a lawsuit. The company I'm in right now, we're involved in a lawsuit. So I'd have to check, but I'm pretty sure we're actually suing somebody. They're not suing us, so our exposure is pretty minimum except for some attorney's cost. But you can see failure to follow government regulations. That's a contingent liability. Guarantees of debt, all that sort of thing. So contingent liability should be entered into the accounting records only if it meets two conditions. The liability must be probable, like it's pretty sure it's going to happen, or the liability can be reasonably estimated. So it has to be probable and it can be estimated. Then it's considered a contingent liability. Briefly, commitment. They're a legal obligation, but it doesn't meet the technical requirements for recognition as a liability. Maybe it's not probable. Maybe it can't be reasonably estimated. An example would include like a purchase agreement, a lease, or commitment for construction, and that sort of thing. And those commitments have to be disclosed in the notes of the financial statements. They wouldn't necessarily show up as a liability on the balance sheet. Okay, that's it. Hope your week goes well. Contact me if you have questions or problems, and hope you have a great week.